Hey, Bernard Wealth Extended Family. Wanted to reach out today. Obviously, the markets have been extremely volatile. Doesn't seem to be any good news on the horizon. And wanted to continue what we talked about previously, which is the we've planned for this mentality and take it one step further. So you notice I'm sharing my screen today, and I want to talk a little bit more about that methodology and try to help you to conceptualize and understand the method of why we've planned, and then how we can look at some of the buckets of our wealth and of our money to say, here's the purpose they serve, which ultimately I think leads us into a situation where we can feel better about an otherwise not so good market. At the end of the video, I'll also give some thoughts and perspective on the market as well, but I think this is important. So we call this your waterfall cash flow. And if we follow these buckets along, what are we looking to accomplish, right? Our standby bucket is really your checking and savings account at the local bank. Money that you need on a standby basis for monthly spending, and potentially your savings account to hold you up and prop you up with some short-term reserves if you should need them. The next bucket down, short term, so still lower risk investments that ultimately are there for shorter horizons. And then you can see as we go, our buckets are getting a little bit bigger because the hope is that we're really saving for the future. We have our short term, intermediate term intact. And as we go, these buckets get bigger and hopefully hold larger sums of investable dollars. So to take that one step further, okay, here's our standby cash at the bottom. We conceptualize that as 3 to 12 months worth of your regular living expenses. And some of that will determine where you're at stage of life. If you're still working, we may say that's maybe 3 to 6 months. If you're retired, well, then maybe we're going to push that out a little further to 12 months. And there's some element of comfort there. Short-term liquidity, this should be your bucket that holds investments and dollars that should take care of your lifestyle for that 1 to 3 years. So again, not taking a whole lot of risk, but having those dollars there to protect us in those shorter term environments. And then obviously as we go intermediate, long term, 3 to 5 years, 5+ years, bigger buckets. So you can see that hierarchy being built. And really the understanding to say is, well, if we can be taken care of in the ultimate short term, 3 to 12 months, 1 to 3 years, this should help to alleviate the anxiety and the emotions tied to our longer term investments as we go through periods in the market like we're facing right now. I'll tie this together in 1 second. This is a very simple risk return scatter plot. So on the left side here, you can see annualized average rate of return. And going across the bottom is our standard deviation, which is how we measure risk. And this is a pretty long period of time. So from the end of 1993 through till March of 2020, you can see where different asset classes have been and have performed. If we could pick the perfect spot to be, we'd be in this upper left-hand corner. Very, very low risk with a very high rate of return. If I could get you all there, we'd be having this conversation on a white sandy beach somewhere, which would be great. We can shoot for that, but it's not our reality right now. So you can see US Treasury bills. That's considered a risk-free or very low risk rate of return investment. And then as we go up, we're expecting to take more risk, but also getting a higher rate of return, right? Makes sense. If we're taking more risk, we want higher rates of return for taking that. You can see the S&P 500 right here. There's gold. Here's a cluster of bonds, private real estate. So now what we're doing is we're going to overlay that same concept we talked about so that you can get a picture of, say, well, standby short term. Again, we've planned for this. Well, we're not going to take risk or any meaningful risk with that bucket of money for our 3 to 12 months worth of spending needs and cash flow. Our next bucket up, short-term liquidity, 1 to 3 years. So again, not a whole lot of risk, and we're not expecting much rates of return. And as we go out, longer-term investments, here's our stock market investments. We're looking at those as 5+ years down the road so that we can live through market cycles with our standby and short-term liquidity, and that we don't have to get overly concerned in the short term because we don't need that money today. We're not looking to spend that. That should not hamstring your lifestyle today for an investment we've planned to use outside of 5 years from now. So that's the methodology behind there. And again, our goal is to help you to feel like some of the emotions can be taken out of the finances so we can make good decisions and not get overwhelmed and take things out of context as it relates to the markets. And now to the markets. Inflation is on everyone's mind and it is driving volatility in both directions. In July, we saw markets rally. I do believe a lot of that was tied to the Fed's kind of rhetoric and the way they're positioning, saying we see inflation improving. And actually, analysts were starting to think that we would see one or two more rate hikes yet this year in 2022 and then move out to 23 with a case for the Fed to lower interest rates out into May. Well, fast forward to August, we get an inflation reading that's higher than expected. It ticked up marginally, but still a tick up wasn't what the market was expecting. And then the Fed comes out and says, we see economic pain ahead. That's frustrating, in my opinion. It's hard for us to plan and make decisions when we have a Fed that one day seems to think things are working and the next day is kind of on the other side of that paradigm. So we'll continue to navigate through that and determine, what the course is. We do still see a case for inflation to come down through the course of the rest of the year. A lot of the analysts we follow targeting a 4 to 5% range of inflation. If we could get there, I think that's positive ultimately. The Fed is looking to get back down to 2%, which I don't think is likely. And I think if that happens, the Fed would have pushed us into a recession in the short term by raising rates really quickly to really stop this problem. So I'm not sure that that's really going to happen, but it's something of consequence to pay attention to. Underlying, industrial numbers came out last week. Overall, things continue to look good. We're growing as a country, albeit small. We're still trending in the right direction. We're not seeing big, fast, growth that we had in the last couple of years, but we are, still on solid footing. So I think overall, we're still dealing with inflation. That's what's driving, every conversation that every investor, has, and that really is the catalyst here that needs to resolve in order to move forward. Again, to my point earlier, in talking about we've planned for this and talking about how we allocate these buckets, this isn't something that I think you need to be overly concerned about. If we've done our planning right, which I believe we have and we do, and we're very diligent with that, then we really should be thinking about these market cycles and longer term periods in time, and being feeling confident that we're where we need to be from a planning perspective, and hopefully that shows real value to you and to your family. It doesn't make it easier, unfortunately, to stomach this and hear what's happening. So we're certainly sympathetic to that, and we want to be here for you too for more and more conversations. So if you're concerned about this, it really is bothering you, by all means reach out. Our team is going to do our proactive job to schedule our normal meetings. But if this is something that you need some reiteration and all, that's what we're here for. We're here to help you. So please feel free to reach out. Thanks, and hopefully next time we talk, we'll have more positive things to talk about. Take care.